Okay, chapter 4. Financial instruments. Now I will define what is financial instrument later. First see the rules. Which rules governing this financial instrument? There are two accounting standards. One is IAS 39. First is IAS 39. It was originated in 2005. And the current development, you can see IFRS number 9 in 2008. So these are the two major accounting standards for financial instruments. Another key standard, because when we buy a car, we have to take loan, right? When we buy a house, we have to take loan, right? When we study, also have to take loan, right? So how we are going to account for that, all are given here. So every human being have to know about this. Nobody can run away from taking loan. So this is all about how to do accounting entries if the business take what? Loans. To better learn this one. It's not something isolated. Like PPE, very important. The leasing also now very important. This is another accounting standard, very important. So first, what we are going to see. So first we start defining what is the meaning of financial instruments. What is financial instruments? The second point, how to differentiate between debt and equity. How you distinguish between, you know what is distinguish, right? What is debt? Utang. Equity, ownership. And number three, equities. Ownership. And number four, financial liabilities. Utang lah, financial liabilities. And finally, very fast we'll run through what financial assets. Now your class test I designed very excellent paper. I put in such a way it covers everything in 1 hour exam. Got calculation, critical thinking, okay, taxonomy, Bloom, lower level thinking. You memorize and write. You don't also memorize and write. Okay, critically you have to analyze, calculation, all is blended. Get the paper ready. It covers everything, so you have to know everything. So don't ask me which area is important. Everything is important. Okay. So let's start with the meaning. Meaning of financial instruments. So in the meeting, anybody asks, okay, you are an accountant, anybody asks, so I don't understand financial instrument. Maybe the CEO don't know, or maybe a person don't know what is financial instrument. You must be able to explain to them. It's a simple contract or agreement between two entities. Between company A or company B. Okay? Between you and me. Okay? You and me. Contract agreement between two parties. That after you go into the agreement, one of the party will get FA. What is FA? Financial asset. one of the party will have what? Financial asset. Asset always what? Balance. Debit balance. And at the same time, another entity will have FL. What is FL? Financial liability. Other party will have what? Financial liability. Liability always what? Balance. Ready? Or E is what? Equity. Or when you enter into the contract, the product, okay, eventually one of the member will have asset. Say, I enter with you. I enter with you. Huh? After the transaction happened, I got asset. In my books, I debit 100. I got asset. Maybe in your book, what you do? You credit liability or equity. That completes the agreement. So you must be able to define this in your class test. Okay? So this is the lowest level in your taxonomy book. Maybe you don't understand, you memorize. Some of you memorize. Understand or not, different story. Lowest level, you memorize knowledge. Yeah? After that, must give example. You give example. Now I go to the basic example you learn in FA1. Listen first, I go for listen first. I'm going to give you some examples. The first example you learn in FA1. Okay? In FA1, let's say company A sell goods to company B, credit sales. Credit sales. What company A will do? What entry they will do? Sales account they credit. Trade receivable, what they do? Debit. Company B will buy, purchase on credit. Company B will purchase debit. Payable what? Debit. So this transaction will give, you all know, receivable is an asset, right? Current asset, right? Yes or no? So that is a financial asset. Payable is a current liability, right? That will give you a financial liability. So you see, this contract agreement gives you an asset here and a liability there. So this is an example of financial instrument that you did in FA1. Example. The simplest I can give, tell you examples of financial instruments. So this is a financial asset, FA, and this is FA. Financial asset. Asset for company A. Okay? Financial asset. Company B, this is a financial liability. So if you ask you to explain, give at least one example. Give at least one example. Okay. Okay. See another example. Another example also, you already learned already. FA2 you learn. Okay. Listen to this. Listen. This you learn in FA2. See. Let's say company P. They issue shares to company R. Company P, they issue shares. They want more capital, they sell the share to company R. They sell the share. So when they sell the share, for them they collect money. Then debit, credit what? Share capital is what company P will do. So they collect money. Company R, money goes out. Then credit. Debit what? Investment for company R. It's an investment in company P. So after they go into this transaction, this simple contract will give you company P. What is this? Equity. For company R, what is this? Financial asset. So this transaction, one having equity, another one having what? Asset. So you have debit, you have credit. This is another example. One more time. Equities means the residual, the balance interest in the what? Assets. After you minus all this. And remember, if this less than this, you get a negative. If negative means problem. Especially corporate companies, they have to subject for liquidation. Liquidation means close the business. Okay? The process of liquidation, all you learn in company law. Huh? Okay. So you define. So Helena. Okay. Now, what is the examples of equity? Some equity you came across in FA2. It's not a new thing for you. Some of the equity you already learned in FA2. Remember ordinary share capital? Jeffrey? You came for LCCI class, right? Don't tell me I didn't teach you. Jeffrey? This girl? You? Law? Some of you came, right? I did mention ordinary share capital. I did under limited company. Ordinary share capital is a equity. It shows equity ownership. Ordinary share. In that class, I gave the differences between ordinary share and preference share. PowerPoint presentation I did. And I say ordinary share, the real owner, they care for you. Rain or shine, they will be with you. They don't run away. Okay? Care for you always. Never pay dividend, also never mind. Trust you forever. That is ordinary share. A true partner. So when you get your life partner, must be ordinary share. Don't get a preference share. Preference share, money will be with you. No money, find another one. So always get an ordinary share partner in your life. Okay? Understand? Must care for you, not for your money. Now another example, non-redeemable preference share. I will explain what is this later. Non-redeemable preference share. That is another example of equity. Ordinary share capital. Another example, non-redeemable preference share. I will explain what is non-redeemable later. Now other examples, this one. Other component of equity. Other component of equity. Other component of equity is a new term. If you see ACCA professional exam, they are using this term. Other component of equity. This is a new term. The old term is reserves. Old term is what? Reserves. What is the new term? Other component of equity. Now reserves, you learned already. Share premium, profit and loss, general reserve, revaluation reserve. So all these are considered under equity ownership. So what are the examples of equity? Ordinary share, non-redeemable preference share, other component of equity. What are the examples of other component of equity? Share premium, profit and loss, general reserve, revaluation reserve. So all these consider equity ownership. Secondly, show some body language lah. Don't be like statue there. I don't know whether you copy it or not. Do something like this. This and ready. Something like this. Okay. I don't know. Copy ready. Okay. Now let us see what is the meaning I told you just now. Redeemable, non-redeemable. Okay. Okay, there. Preference share capital. Preference share capital, one way of classification is redeemable preference share, redeemable. Another one is what? Non-redeemable preference share. Redeemable, the opposite is what? Non-redeemable. Okay. Redeemable preference share, non-redeemable preference share. In lower level FA2, we always assume preference share is equity. That was a basic assumption. At lower level, we never define or classify the preference share capital in this way. We always assume preference share as a what? Equity. That was our lower level FA2. But here, we go more detailed. Preference share capital got two types, redeemable and non-redeemable. Now, what is the meaning redeemable? That is the meaning. The time period for the dividend payment and repayment of capital already specified in the contract. The time period for dividend payment and the repayment of capital already specified in the contract clearly. Okay. Let's say you are my preferred shareholder in my business, and you already say 5 years only. After that, I must pay you back the capital. That is in the contract. You want to run away from me. Okay? Sorry, specify. That means by the 5th year, I have to find enough money to pay you, right? Or not? It's already in the contract. I promise you already. If I have to pay you 1 million, I must have the 1 million finance to pay you. That is redeemable. Okay? So that put me a pressure to get the finance for you. So, as an accountant, don't think like a lawyer, strictly rule book, use your common sense now. Is it a liability or equity? Below that, don't go and see. It is not to see inside. Is this a liability or equity? Tell me. The answer is there. I am going to give you. Is it a liability or equity? I have to find the money to pay you, Liability or equity? Remember, equity, care for me. Equity, care for me, Oh, automatically want the money, why? Equity or liability? Financial liability. This is a financial liability in substance. Okay? In the contract, I cannot do a negotiation. No. Financial liability. So where you show in your SOFP, current liability or non-current liability. If I have to pay her more than 1 year, NCL. If I have to pay you within 1 year, CL. Therefore, the dividend that I pay her, where I enter, expenses or SOCE. You know what is SOCE? Where we learn SOCE? Chapter 1. Wait. SOCE. Remember SOCE got many columns. And the first one is the equity share, P&L, blah 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 blah. Then I put the dividend here, remember? And I minus from the P&L, remember? Now the question I'm asking, I have to pay a dividend every year, right? The dividend I enter here or in my finance cost as expenses. And this is a liability. So the dividend I pay here, I enter here or in the finance cost. That is the next answer. Finance cost. So this preferred dividend I pay to her won't come here. It is a finance cost. Why finance cost? It is a liability. Here, if you put here, this is an equity dividend. So redeemable preference share capital are liability. The dividend payment is a finance cost. Okay. Now see this one. What is the opposite for this? Now can you write on your own the sentence? I leave it blank. Can you write on your own? Can you write what is non-redeemable preference? Exactly opposite. Just write exactly opposite. Don't write the exactly opposite. Okay. Write the sentence. I wrote there. Right. Just write the opposite sentence for this. Don't write exactly opposite. So what you can write? The time period for dividend payment and repayment of capital not specified in the contract. Just add the word not specified. Don't know when. You tell me don't know. Like me very much, don't know when. Okay? Forever want to be the shareholder. This one, 5 years only. This one, 10 years only. After that, want to run away. Forever. So now tell me, by nature, is this equity or liability? She never back me, for the finance. Give me back my capital, no. So by nature, equity or liability? Equity. So this shows equity ownership. So therefore this is equity ownership. Therefore, the preferred dividend that you pay will appear as a finance cost or enter here in your SOCE. So the preferred dividend, I put bracket SOCE means show here. That is the meaning. This one show where? Finance cost. You know finance cost, right? You know where we put finance cost? Revenue minus what? Cost of sales, what do you get? Gross profit, other income, distribution costs, admin expenses, other expenses. Remember the finance costs I minus here? There. So now, clear? Huh? These two. Okay, next. Continue. Now, what is the meaning initial measurement? I use this abbreviation IM. Initial measurement. Initial measurement means what is the initial value when we enter into the contract? Originally, how much we record? That is the meaning initial measurement. What is the meaning initial measurement? The value that we record in our books at the beginning of the contract. Like here, let's say I record 100, and that is initial measurement. Initial means awal. IM is initial measurement. Then what is subsequent measurement? So what is the subsequent? So lanjutnya, right? So after 1 year, let's say you record the value of equity, here you record. After 1 year, end of the year, how much is the value? Maybe a different value, maybe same value. So that value what we call subsequent measurement. Second year, how much you record? Third year, how much you record? That's what we call subsequent measurement. Now these two terms I will be using very frequently after this. Then you should know what I'm talking. IM, initial measurement. SM, subsequent measurement. What is initial measurement? The valuation of the financial instrument at the beginning of the contract. Subsequent measurement, what is the value at the balance sheet date? Maybe after 1 year, 2 year, and so on. Clear? Okay. Now, what is how you measure equity initially? Let's say I issue ordinary share. Okay. How I measure at the beginning of the year? What is the equation given by the standard? So the initial measurement for equity. How you measure? Fair value, okay, market value, minus what? Issue cost. I sell the share to the public. I issue the share. The fair value of the share minus the issue cost. That is the equation. That's how you measure the equity initially. Fair value minus issue cost. So what is fair value? The market value of the share, the selling price of the share. Say one share, I sell 10 ringgit, I sell 100 share, 100 times 10. That is the fair value. Now what is issue cost? What is issue cost? Expenses incurred in the process of issuing the shares. I issue shares to the public. What are the expenses I incur? Okay. What are the expenses the company incur? Issue cost. Expenses incurred in the process of issuing the shares. Let's say Astro did a public listing. Maxis did a public listing. They sell the share to the public. Okay. So there will be definitely expenses incurred. There will be stamp duty, agent fees, okay, processing fees for the merchant bank, a lot of fees they have to pay. Is this recurring or one-off expenses? Company sells the share, like what I did just now. Is it a one-off or recurring expenses? Say I run a furniture company, public listed. I sell the share to my shareholders. So the issue was, is it my normal business expenses or one-off expenses? One-off expenses. If one-off expenses, I wrote them not OE. What is not OE? Operating expenses. It is not operating expenses. Okay? So can you put this in your operating expenses? Can you credit cash or bank debit expenses? Cannot. And these are the kind of question at this level they will ask. So the scenario will tell the director or finance director, okay, the issue cost event and enter in the expenses. Can you explain? Can you critically evaluate this decision? So what is your answer? So you learn this accounting standard. So you have to tell what the director did is incorrect. Why incorrect? The issue cost based on this accounting standard is not a business expenses. This should be deducted from the fair value. It is not a business expenses. This is a higher thinking level already, not a taxonomy group. You cannot memorize. You see? This is not a building. This is what you learn. Issue cost minus here. In the exam question, what they will tell this particular trading accountant or finance director or whatever director, you go and put the issue cost in the business expenses. So you have to write a report. You did correct or wrong. You have to explain. So how to explain? Based on this accounting standard, IAS whatever, this standard say the issue cost must be deducted from the fair value. But what the director did, he go and put in the expenses. What he did is wrong because the issue cost is a one-off expenses incurred in the process of issuing shares, not the business expenses. Therefore, what the director did is not correct. That is where the taxonomy group, higher order level things, you cannot memorize the kind of answer. And I love that kind of question because I don't need to memorize before I go to exam hall. I don't like the meaning of financial instrument. I have to memorize it all. The meaning of financial instrument I have to memorize, right? Okay? This one I know it, application. I understand this, I apply. I like to do this. Next. Now this division, you should know, total don't know. Equity share always you record at what value? Par value. Equity share always record at what value? Par value. Don't ask me what is par value, please. Okay? You already did in FA2. This is not a place to ask me, sir, explain what is par value. Please. Please. Par value I explained for half an hour in FA2. Okay? Don't ask me what is par value now. Please. You are expected to know. So equity share always record at what? Par value. It's a rule you have to know. Issue cost. Issue cost you write off against share premium. Write off in tola dari share premium. Itu maksud dia. When I say write off means what? Tola dari. Tola dari share premium. Bukan tola. Bukan tola. Ini tola. Ini tola. Bukan tola. Write off means what? Minus from share premium. That means your share premium have to come down. Okay. So when you see the double entry, issue cost, duit keluar, cash or bank credit, what account you debit? Share premium debit. That is the entry for issue cost. Then don't ask me what is share premium. Okay? Give you some more the formula already, all you learn already. What is share premium? How to calculate share premium? Selling price of the share minus the par value of the share. Company sells the share 6 ringgit. The basic value is 1 ringgit. The difference will give you 5 ringgit is a share premium. Issue price minus par value is the share premium. How much extra worth of your share? The higher this is better, correct or not? The higher is better, right? Premium means very good, right? So the higher the value is better, right? Premium. Okay. So initial measurement, I repeat, how to measure initially? Fair value minus issue cost. Fair value minus issue cost. Initial measurement. Now, how to measure subsequently? How to measure subsequently? Subsequent measurement. Initial measurement, you know. After first year, second year, how I am going to value the share? Subsequent measurement of equity. So initial measurement at fair value minus issue cost. 1 year finish. How I am going to measure how the company is going to measure the equity? That is subsequent measurement. Now the rule is the standard say company will not remeasure the equity. Company not going to remeasure the equity. They are not going to revalue the equity. Company will not remeasure the equity. In beginning of the year par value 100, end of the year par value still remain 100. Company is not going to remeasure the equity. Another way to say the equity value, par value will remain the same. In another way, the equity par value will remain the same. Par value will remain the same. Why? Why company will remeasure the equity? Why? They don't know how to remeasure. They don't know the formula. They forget the formula. Why they don't remeasure? Because that's how I heard because, huh? Okay. Don't tell me I don't know spelling. That is the abbreviation I use for because. Okay. BECUSE. That is the abbreviation I use. That's why it must be FA1, FA2, you learn in P. So because BECUSE is this one, okay, right? Because the changes, this delta changes, because the changes in fair value will be recognized by the owner, the investor, not the company. The changes, who will observe? The investor will observe. Okay? So you buy the share. Let's say the share value is going to go up. You want to make money, sell the share to her. And this company is still the same. You also one day want to leave, sell to her. who is observing? The investor is observing. As far as the company is still the same. Okay. That's right. Because the changes in the fair value will be recognized by the shareholders, the investors. Can I scroll up? Dividend paid. The dividend I paid, the company paid to the shareholders. That is a double entry I do. The equity dividend I pay, I credit cash or bank, debit retained earning. Remember, dividend I minus here in the P&L. The retained earning I minus, right? Debit. So debit retained earning, credit cash or bank. I don't debit share capital. The dividend I pay, I don't debit. Did I debit this column? No, I debit from the P&L. So I say no reduction in equity shares. Now we are going to do some activity. I will show you activity 1, activity 2 you have to do. And this is coming in your class test. Okay? This activity is coming in your class examination. Take down. Right, that's example 1. Right, this is example 1. Activity 1. Maggie Berhad issued 100 million. Maggie Berhad issued 100 million equity share. They sell how many share? 100 million. What is 50 cents here? Par value. One share par value 50 cents. One share. Okay. Issue price 30% above the par value. Can you put in pencil? How much is the issue price? 30% higher. Just take a calculator and put that. Calculate the issue price. What is the selling price? 30% above 50 cents. $0.65. Is it 65 cents? 65 cents, right? Okay. So the selling price of the share is 65 cents. Par value 50 cents. They sell 65 cents. What is IC? Issue cost. What is IC? Issue cost. Okay. Issue cost. Our understanding. But if I go and ask anybody, IC, what is the meaning IC here? Issue cost. If I go there, I ask anybody IC, they know what is the IC means. Here, what is the meaning? Actually, no. Issue cost is 0.25% of cash proceed. And you have to know what is this cash proceed. And you know, Dokas, I tell you, don't know what is cash proceed. It's all language problem. Giving me a lot of headache. 0.25% times cash proceed. What is cash proceed? Don't know. Okay? You know 0.25% times cash proceed. Cash proceed. And here I have to explain. You know what is cash proceed. Show what? R means what? Show what? Journal entry for IM. What is IM? Initial measurement. All the calculation must be to here as 1000. Okay. Ready? I have to give you the answer. Ready? Prepare the plan first. Prepare the plan. By the Maggie Berhad books. Right what? Maggie Berhad books. Underline. Journal entry to show initial measurement. Journal entry to show initial measurement. Journal entries to show initial measurement. And for date, particulars, debit, credit. Date, particulars, debit, credit. Quarter page will do. Quarter page will do. Don't prepare a quarter page answer enough. Date, particulars, debit, credit. Water bottle back. Now, water. Exhausted. Okay. Now, Maggie Berhad issued. In layman, just understand, sell the share. Maggie Berhad, sell the share. Sell. How many shares they sell? 100 million. Wait, Mashokar Kulwa. I sell to you. Collect money, right? Wait, Mashok. That's why I debit cash or bank. You can see. That's why I debit cash or bank. Now, how the calculation? How many shares I sell? 100 million. What is your selling price? You have calculated already? That's how to calculate. 100 million times it's 65 cents per share. How much I collect money? 65 million. 65 million. Debit with my show. Credit what share? What is the name of the share given? What is the name? I put equity share. Follow lah. Don't write ordinary share. If there equity share, you also what? Equity share. Preference share. Preference share. Equity share. Equity share. Ordinary share. Ordinary share. Preference share. Preference share. Rani share. Rani share. Raja share. Raja share. Can see. Let's follow the term. Equity share. I credit. $100 million. Remember the rule. The equity share always at what value? Always at what value? Par value. The rule. We always record at par value. So 100 million times 50 cents. How much here? 50 million. And the balance money will go where? Share premium. 100 million. How to calculate share premium? 65 cents minus 50 cents. That will give me double line. Double line the entries. That is a journal entry. record initial measurement. Cash or bank debit, credit equity share, credit share premium. Now, what is the meaning cash proceed? Cash proceed means the total money you receive from the issue of shares. The total money that you receive from selling the share is cash proceed. How much they collect money in full? 65 million they collect. Now, calculate. Issue cost entry. How many percent issue cost? 0.25% times how much they collect? 65 million. Here a graph for you. Is it 162.5? Right. Debit what? Share premium. 0.25%, huh? Yeah, 162.5. So share premium debit, cash or bank, credit. Okay, now you do one activity for me. Based on IAS 39, financial liability categorized into 2 types. One, fair value through P&L, another one, amortized cost. Okay. First we see what? B. Okay, yeah? See B. B first. So method B, amortization cost method. First initial measurement, I go into a contract. The company took a liability, and under this method, how they measure the financial liability? Fair value again minus issue cost. Fair value minus issue cost. Financial liability value equal to fair value minus issue cost. So initial measurement, financial liability value, we measure fair value minus issue cost. Initially we measure using this equation. Again same reason why minus issue cost, same reason as what I told just now. This is a one-off expenditure, it's not a business expenses, that's why we don't put there, we have to minus here. That is initial measurement. Subsequent measurement, we use amortized cost method. Subsequently, how you measure? Amortized cost method. What is that? You will know when I show you the exercise. The subsequent measurement at amortized cost method. Machine. Before we go see the activity or case study, there are few formula or terms you have to know. These are new terms for you. The first one, coupon payment. So you have to understand clearly the coupon payment. What is this coupon payment? Coupon payment. Not the, I remember those days, canteen, Hari canteen, coupon, those days. Not that coupon. What is coupon payment? I defined already. What is coupon payment? It's a predetermined. You know what is predetermined? Predetermined, don't know. Contractual? Don't know. Cash flow? Don't know. Based on? Don't know. Financial capacity? Give example. You are very rich one. Yeah, I'm very poor. You went buy an asset, 50,000. 50,000 asset. I every month can pay 100 ringgit only. I say the bank I can pay 100 ringgit. You're very rich, you can pay every month 2,000. So the bank put agreement based on my financial capacity. The bank say based on your capacity, every month you pay 100, but maybe for 20 years or 30 years. You pay 2,000. Based on your capacity, they say 5 years you must pay back. So every month I pay 100 ringgit. You pay 2,000. Same loan amount, right? So the bank already calculated earlier. Predetermined means that it will look at how much you have to pay. How much I have to pay 100 ringgit. How much he has to pay? 2,000. Based on financial capacity. Kemampuan lah. Why I have to pay lower? Because poor. That's why very high. Kemampuan saya rendah. Kemampuan dia tinggi. Yesterday night I was eating the 80-cent bread. Student was eating the what? The famous cake house. Secret recipe. I was eating the 80 sen punya. 10 ringgit. Saya punya kemampuan 80 sen. Dia punya kemampuan 10 ringgit. Financial capacity. Yeah. So that is a mini coupon payment. Now how you calculate coupon payment? Coupon rate. This is a fixed rate. Coupon rate won't change. Coupon rate is fixed already. The bank agreed to you 5%, 10%. Coupon rate is fixed. Times it. Par value of financial liability. Par value of financial liability. So this is a fixed value. This is a fixed value. Fixed value times with fixed value, you get a fixed value, right? Okay. A fixed value times with a fixed value, you get a fixed value. So coupon payment will not change over the contract. It's already agreed already. It's already agreed with the bank. Every month you have to pay this amount for 30 years. That is agreed. That's how to calculate your coupon payment. Coupon rate times the par value of the loan. Coupon payment. So coupon payment is this value already decided before the commencement of the contract. Next. What is FC? Finance cost. What is IOL? Interest on loan. So how you calculate finance cost? How you calculate finance cost? The bank will charge you interest, right? You take loan, they will charge you interest, right? So how you calculate the finance cost? Because the finance cost is calculated based on effective interest rate. Remember chapter 1, when I did chapter 1, remember one of the questions was effective interest rate, then I said I will explain later. EIR stands for effective interest rate. Effective interest rate is a market interest rate. Okay? Different bank will have different interest rate, but the BLR decided by the Bank Nagara. So effective interest rate is the market interest rate times what is CV. Better tell me last time CV must know by now. CV. How many times I told CV? Carrying value, right? Something student don't know what is CV. Carrying value. NBV, PPE, FA, FL. So how you calculate the interest on loan? Interest on loan, use the market interest rate. Don't use coupon rate. Use the market interest rate times with the carrying value of the loan. Carrying value of the loan. I stop here. You go for break. Come back 11:30. Then I will take one activity and start. I know already. You all out. Yeah.